Hi everyone, my name's David and welcome to this first topic in accounting for managerial decisions for autumn 2020. For those of you who were with us in class, welcome again, and I hope this is useful for you. For those of you who were not able to make it into class, and we realize there's some obviously quite serious things going on around the world, we hope you're doing well, and we hope that these series of recordings will be useful for you in your journey with us. For those of you who have nothing to do with the subject, welcome also. I hope this is useful, and obviously, reach out through the various sort of channels through that we made available through YouTube to get in touch with us if you have questions. This particular topic is setting the scene for the rest of the session. So it's an introduction to accounting and decision making. So we look at kind of some higher level things about what accounting is, the environment in which it works within, and then we start to delve into some of the regulatory aspects in relation to accounting in Australia. So in terms of where we're going across this particular topic in a little bit more detail, so we're going to look at what accounting is and the importance of accounting and its role in decision making by various users. That decision making aspect is quite important. We're going to look at the difference between financial accounting and management accounting. Financial accounting is the focus for the first 5 topics leading into financial statement analysis, which is the 6th. Management accounting is then what we end up looking at towards the back half of our time together. We'll look at how accounting information is used in the business planning process. We'll then touch on sustainability, which, if we're living in Australia or, notice what was happening in Australia across kind of December, January, February, certainly there are elements around what's happening in the world which are coming to the fore. We'll look at reporting in relation to sustainability at that point. Then we move in a slightly different direction into then company regulation in Australia. So why accounting and where it's mandated. Then touching on the conceptual framework. So what the regulators see the purpose of accounting, and then some of the key qualitative characteristics of financial statements. And to round it out, as much as, I am an accountant and I think accounting is great, there are some limitations to it. So we'll look at some of those to round it out. So the accounting process. So accounting, there's a number of different definitions for it, but one which kind of captures it for the most part is it is the process of identifying, measuring, and communicating economic information about an entity to a variety of users for decision-making purposes. So there is that sort of collating and pulling information together. It's information of a certain sort. It's economic information. There are lots of other types of information which are useful for decision makers and are useful for stakeholders in the entity, but accounting very much focuses on economic information. A really key part of what accounting is it's for decision making. People have to be able to do something with it. It's not just a matter of kind of collecting it and collating it and storing it on a shelf somewhere. It's actually going to be useful, well, hopefully useful for people to make decisions with. There obviously are limitations to this, but the idea is that people can do something with this information. Now, this graphic on the right-hand side is from the American Accounting Association from a few years ago. And I think it neatly encapsulates, I suppose, the perception and reality of accounting. There's this view that accounting and accountants will be just overtaken by computer technology and we won't have jobs anymore. And this is based on this notion that accounting is very mechanistic in nature. And there is some element of truth to that. Certain parts of the accounting function are being automated. They have been automated for some time, and they will continue to be automated. The reality is, certainly in financial reporting, that there's a huge amount of professional judgment, and there's a huge amount of estimation and subjectivity which goes into the creation of this useful information. That I suppose gives rise to a concern that accounting can be whatever you want it to be, and yes, people do take advantage of that, but there is an important element to having a level of subjectivity and the ability for entities to make decisions for their own circumstances, because each entity is different. The circumstances around each entity are different. So there, it is important that judgment is being made there. So the idea is that if you look on the bottom right-hand side, economic activity is happening, people are working, companies are buying product, they're manufacturing, they're value adding to it, they're selling product, they're borrowing money, they're doing a whole range of things every single day. And the idea is to how to take that economic activity and to convey that to the users in some way which is useful. Now, that's not an easy process necessarily. And then from there, people are making decisions with that information. What sort of people? Now, there are both internal and external users. As you mentioned at the top, we talk about financial and management accounting. There are obviously internal users. If you've ever been involved in setting budgets, if you've been involved in day-to-day operations, there's information that you need to be able to do your job. We will look at those elements and those parts of decision making in the last 5 or 6 topics. When we're looking at external users, this is the financial reporting function. So this is when we ask you to look at Woolworths. So Woolworths provide their financial statements. These are general purpose financial statements and are read and are used by a wide variety of people. Whether they be shareholders, customers, employees, the government, suppliers could be of interest. There could be environmental groups that look at this sort of thing. There are a range of different users out there that are interested in this. And they will have slightly different decisions that they'd be of interest, or they will have that they're interested in making. If you look at suppliers, for example, suppliers obviously supply goods and services to particular organizations. And if they're supplying and their relationships are longer term in nature, if whoever they're supplying to runs into financial difficulty and leaves the market or collapses for whatever reason, that's going to potentially put that supplier at risk. In an Australian context, we've seen the complete removal, I should say. Maybe it's not quite the right word, but the automobile industry, there are no cars manufactured now in Australia. There would have been a number of suppliers to that industry, which now will have to have found different organizations to supply to if they want to stay operating. So taking this idea of different users, one of the things we did in class, and obviously, if you're in class, you already have done this. If you missed it and you're catching up, or you haven't been able to make it to class, one of the things we would like you to do at this point is, if you're watching this, obviously you're watching this on video, pause the video, give yourself 5 or 10 minutes, and for each of the following user groups, identify at least one reason why accounting information could be useful for them. So shareholders, customers, employees, and the government. What sort of decisions would they be making with that information? What sort of information would be useful for them? Why would they be using that information? So if you're within the subject and you're having a look at this, take your time, come up with an idea for each one of them. And then if you want, we're setting up a section in the module where there's a discussion forum. And so please, if you've got sort of any thoughts, please post them up within that forum. And, if you're another student and you see someone has posted something there, please feel free to respond. It's great to sort of everyone to buy in. I'll obviously be keeping an eye on things as well. Turning now to financial accounting, which, I suppose the difference between financial and management accounting, but financial accounting is the starting point. Financial accounting is interested with the preparation and presentation of financial statements. So these, as we looked at with Woolworths, but publicly listed companies provide information out to the market, and these are the financial statements that we see. and it allows people external to the business to make decisions about the entity. They are a set of statements, and as noted before, and I've kind of touched on it, it's a common information need of a wide range of users. No individual user has, certainly not smaller shareholders, certainly not non-shareholders for the most part, have the power to be able to compel companies to provide this information to them. So there is a requirement, as we'll see later on, where companies, have a mandatory disclosure of these statements. And that's so that people can make those decisions with them. There are five statements within this, the three of which we'll focus on. So the statement of profit or loss, the statement of financial position, and the statement of cash flows, and we'll spend a week or a topic on each. There are a couple of other ones, changes in equity and OCI, or other comprehensive income. These are not a focus for what we're looking at across our time together. But if you have questions on those, please feel absolutely free to get in touch. Management accounting is taking an internal view. So this is economic information for internal users. This is often reflected in the financial accounting statements for external users, but it's about planning and decision-making internally. And they talk about future events. For all of us right here and now dealing with Corona or COVID-19, no one really knows what the future is like, but it's useful to put in place some level of contingencies around, well, what could happen based on certain events happening. Certainly, sporting events, we're seeing major sort of disruptions in that space. The NBA, I think, is shut down. A lot of football leagues up in Europe are either not happening or they're running without crowds. The F1, the Formula One in Melbourne I think it is running, but again, they're going with no crowds in it. And those are going to have implications for the sustainability of those events. So looking at budgets and plans, and then it helps you provide some level of day-to-day monitoring of what's going on and control, but also sort of an ex post or after the fact evaluation of what took place. So turning to business planning, look, there are obviously benefits. I mean, planning in general, there are benefits to do it. Anything future looking, none of us can predict the future. I mean, I'm sure towards the back end of 2019, if anyone suggested what 2020 was already going to be looking like, no one was really going to predict how this is unfolding. Certainly, I was expecting quite a different year, and it was going to be getting a lot done, and I am getting a lot done. It's just dealing with circumstances which no one really thought was going to be in effect towards Christmas. So what a business plan does is provide that direction on and purpose of where you're going as an organization. And that's helpful because if you want to try to get somewhere, it's good to know where you're going. And it's good for obviously management to be aware of that if they're leading from a strategic point of view. But it's also helpful for employees that they actually know what they're working towards. A lot of things we do in work, and reflect on the work that you do, a lot of things on a day-to-day basis, you kind of wonder why you end up doing them. It's not, you could argue that a lot of those times aren't necessarily all that fulfilling. But it's that bigger picture that we're working towards that make those day-to-day things valuable. So if people know what they're working towards, and again, this is moving slightly outside of accounting, from a psychological point of view, it's very helpful. And it also helps ex post the business to understand and to give you an idea of how to evaluate the business. If you don't know what you're working towards, how do you know if you've got there, and how do you know how much you missed it by if you missed it? Appreciate there's a bit of content on this, but if you look on the left-hand side, we're very much looking at, well, how does business planning and how does accounting help with this on a kind of operational level? And if we look at the right-hand side, it looks at, well, now the period has come to an end and we're looking back. How does it help? How does accounting help give us a sense of what has happened? Did we get to where we needed to go? So if we look at the operational side, accounting information provides managers and owners with the tools they require to make decisions regarding daily operations and evaluate whether goals set by the business entity in the planning entity are being achieved. So if you're thinking at A level, sales targets, if you have a general idea of where you want to get to, and then you can look at sort of daily sales, weekly sales, are you getting to where you need to be? What are the things and decisions you need to make to help assist meet those targets? So those are important. If you look sort of step below that with cost, volume, profit, how does profit change as volumes change, as cost change, as prices change? And we'll spend a topic looking at this and how mechanically it works together, but also, things to consider with this. But if you understand how those elements sort of move together, then it helps you kind of plan out what could happen and where things lie, and where you need to meet, where you need to get to break even, and what sort of things need to be done. So again, we'll spend a whole topic looking at cost, volume, profit analysis. In terms of evaluating the business plan, you need some way to tell whether you've succeeded with what you've done. Now, there are lots of different ways and lots of different metrics it could be used. It could be on, customer satisfaction. It could be on time running. It could be a whole range of different KPIs and work health and safety type ones as well. These are all important, but so are sort of accounting numbers. Knowing, did you make the sales levels you did? Did you get costs down to where you needed them to be? Not saying the accounting numbers are the be-all and end-all, but they are an important part of this information set to evaluate what you've done. Because ultimately, if a business runs out of cash, it's going to have a problem being sustainable into the future. And talking of sustainability, in a slightly different way, I think you'd have to be, I'd say, living under a rock not to be aware that there are issues going on in the world around us. But not trying to be disrespectful of anyone who is not aware of these things. But obviously there is an increasing concern in the way the planet is able to sustain population growth, is able to sustain resource use. And so business sustainability refers to the use of the world's resources in a way that doesn't compromise the ability of future generations to meet their needs. So again, it's very forward-looking. Now, the need in there, so the next line, entities need to account for. Now, that need is quite a strong word in there. And it's interesting when we look at this to start to think about what accounting information does and doesn't have. So we talk about entities need to account for all resources used, whether it be labor, material, energy, forest, water, air, etc., and all the outputs that come from that. Now, obviously, there's the products and services, the outputs that often are saleable. But what about carbon emissions, waste, and so on? So I'll just focus on the outputs here because I think from a tangible point of view, they're easier to measure. But certainly, as we move through the course, we'll touch on elements around how do we think about the costs borne on labor, on material, and so on, and decisions that entities make, and how ethical or not they are. When we look at outputs produced, we saw in Australia a move to attach a price to carbon emissions, because what we're talking about here are externalities. Prior to any sort of pricing on carbon emissions, a lot of the outputs produced by entities, there is no factoring in, there is no pricing in of these things in the accounting statements. So if you look up a financial statement, if you look up a balance sheet, you do not see those things in there. Are they having an effect, and will they have an effect in the long term? Highly likely that they will, but you do not see them pricing in any way, shape, or form. So carbon emissions and trying to put a price on them was a way to try to price these things and to get them more tangibly recognized in the financial statements. If you think about disposable plastic bags used by Australian supermarkets, which they are now no longer used, the price of those things for the supermarkets to buy and just to have use for shoppers would be very, very small and would come out as an expense, and I would say a very small expense for the firm. But the downstream effects of having plastic bags enter into the environment, enter into sort of streams, into particles being broken up and eaten by fish, to ending up in the Pacific Ocean, just swelling all around there and in that massive pool of rubbish, which is somewhere up in the north part of the Pacific. None of that gets captured. And I suppose the question is, should it be? There are a number of key drivers around sustainability, and things that we're seeing. And again, none of this should be all that new. It's how we deal with it, and in which way that we do that's probably important here. The population is growing, and continues to grow. We're seeing climate change effects, and a lot of that seems to be driven by the reliance on fossil fuels. Are we going to be able to change it in a meaningful way? I'm not an expert in that space, so I suppose we'll see what happens and what leadership we have from a sort of government and business leaders. The integration of national economies into the global economy. I mean, certainly, the GFC was an indication of that, and the effects of coronavirus right now, we can very clearly see how integrated out and how much that plays a role in our society. And that leads down into connectivity and communication. It means different sorts of work can be done. It means also that information can be transferred much quicker, and reputations can be destroyed very quickly. It also means that you're able, if you weren't in class when we had this class, you're able to listen to this and potentially halfway around the world, which is fantastic. So there are upsides to these things. When we think about the theories around business sustainability, and there are a number of competing theories in this space, and obviously a lot of, there are quite a number of academics who work and do work in this space and look at these things. Corporate social responsibility is one which we're seeing a lot more discussion around. And that very much focuses on this idea that a corporation has many stakeholders. Obviously shareholders are the owners, but they have employees are going to be an important group, creditors, suppliers, governments, the society that the local community that lives around manufacturing plants is going to be a stakeholder as well. For example, the environment. The question that kind of comes from CSR is, does the entity have a responsibility to consider them all equally? So I'm just going to leave that more there as a question for you to consider, and where your views sort of sit on that. Because when we look at the next theory, you can see it has quite a strong view on who should be considered. And shareholder value is one which has been sort of in primacy now for the last 30 or 40 years, is that shareholder returns are the primary focus. That's it. That's the primary thing you're worried about, and it's because they're the owners of the entity, and that is the thing those are the people, those are the organizations we should be worried about. And sitting behind this is this idea of agency theory, where the managers we have, that shareholders have employed to run the business, they act, and their remit is to act on behalf of shareholders. Now, does this mean that they should just go and pollute the environment willy-nilly, for example? I'd probably say not, because that would probably likely run into trouble, and that could well destroy shareholder value. But there's an interesting tension point between this idea of shareholder value and corporate social responsibility. Stakeholder theory holds that the purpose of an entity is to work for the good of all stakeholder groups, not just to maximize shareholder wealth. So there's quite a lot of crossover between stakeholder theory and CSR, is that idea that it's not just focusing on one particular stakeholder, it's looking at a broader stake of stakeholders. And in that vein, stewardship theory is, again, really along that way. So, I mean, it's worthwhile reading up about these things just to understand there are some slight nuances between them. But what we're seeing with stewardship theory is this idea, if you're taking a longer term view, and we're starting to see the regulators, certainly the ASX is coming out with new corporate governance guidelines. We're seeing institutional investors, people like organizations like BlackRock, starting to take much more longer term and pushing companies to take longer term views and to think about these broader sort of stakeholder groups. So it's that, do you take a broader approach to sustainability, or do you focus more on sort of shareholder wealth? Is probably where it kind of all boils down to. And finally, we talk about legitimacy theory. And this is the idea that entities must conduct operations in accordance with social expectations. And where this sort of stems from is that to be able to operate, society sort of allows entities to operate. If, society, and that's quite an amorphous term, like what is society? And what is socially acceptable? When we think about, and one of the examples I had yesterday, sort of in class, I'm recording this the day after, was thinking about the poker machine industry here in Australia, and that a lot of poker machines are in registered clubs, and we've seen, probably not the last election cycle, but the one before that there's been pushback by certain independents to get rid of poker machines, or at least sort of limit some of what they can do. And some of these clubs make 80-90% of their revenue from poker machines, and a fair proportion of that from the research comes from problem gamblers, and that has quite significant impacts on their lives. So one of the things to try to alleviate this idea that gambling isn't a great thing is that the clubs pushed back with a PR campaign to say the money that we raise goes to help social causes around our local communities, whether it be sporting clubs or other sort of ventures and school groups and whatnot. And that, from again, my personal sort of view of it is for them to try to make sure that society still sees them as a legitimate operation, and they're working within society. They're still a socially acceptable kind of organization, even though where they get their money from, you could argue, can be quite damaging to a section of their customer base. So there are a range of benefits from reporting, and whether it be environmental or sustainability. And one of the things which is important to note in all of this, and I won't go through this line by line, but one of the things at a general level to consider when the benefits of reporting and business sustainability is this type of reporting is voluntary. Financial reporting, balance sheet, profit and loss, these are mandatory statements that need to be provided by these organizations. But environmental reporting, sustainability reporting is very much voluntary, and so there are going to be reputation and brand benefits from doing it. It does, and don't get me wrong, there are benefits for casting a lens over what you do and what organizations do internally, and they may be able to actually help and improve what they do. And in that sense, it's great that these things exist. But there is also an element of signaling that goes on. So whether it be gaining the confidence of investors, whether it be about reputation and brand benefits, whether it be about securing a social license or improved access to investors, being a preferred supplier, that you meet certain criteria, there are a number of benefits that come from these sort of reporting. And then there's also an element of, well, if everyone else is doing this, why aren't you? So even if it is voluntary, it can actually drive behavior to do these sort of things. It's not going to be. We're not going to look at sustainability reporting in much detail from here on. But if you are interested in the types of organizations that look at providing ways to do this, the Global Reporting Initiative at globalreporting.org or the International Integrated Reporting Council at integratedreporting.org are two really useful sites to go and have a look at. Turning now to financial reporting and the regulation around it. So the idea of regulation, and on one hand, people don't like regulation, but having a complete laissez-faire sort of situation, I don't think is all that beneficial. Having it too locked down is not beneficial. It is useful to have regulation, as the idea is it protects different stakeholders, because not every stakeholder is going to be in a position to protect themselves. So we do need to have a baseline level of regulation to help promote, a strong, vibrant economy. And the main source of company regulation in Australia is the Corporations Act. This is enforced by ASIC. And the Act, importantly for us in relation to the accounting side of things, the Act stipulates that disclosing entities must prepare financial statements, and in doing so comply with accounting standards and regulations. So disclosing entities is an entity that issues securities that are quoted on a stock market or made available to the public via a prospectus. Disclosing entities have to prepare financial statements. So it's a mandatory reporting regime. And look, there are a range of other regulators. So the ASX, so if a company is listed on the ASX, then they have to meet the ASX listing requirements, which often require a certain amount of information to be disclosed, including financial statements. The Competition Commission, so the ACCC, the Reserve Bank, the RBA, Prudential Authority, so the APRA, and Tax, or Tax Authority, the ATO. So there are a number of other organisations which are interested in corporate regulation here in Australia. We're more focused on the fact that there is a requirement for companies to disclose this information. What you see in a financial statement is not just up to the company about how they do things. There are accounting standards, so the Australian accounting standards, which are still being used and get updated, depends on which. Certain standards come out sort of quite regularly, so it's good to keep on top of things. For example, quite recently we had a change in the revenue standard, so how companies account for revenue is different now to how it used to be done. But prior to 2005, Australian accounting standards were developed by the Australian Accounting Standards Board, or the AASB. Since 2005, Australian entities have complied with international financial reporting standards, and these are issued out of London from the International Accounting Standards Board. The International Accounting Standards Board is basically, not interested. I mean, what its role is to create and disseminate accounting standards, or the IFRS, and at the moment there's about 140 countries around the world that use them. So we use them: New Zealand, South Africa, Hong Kong, the EU, England, because they're now no longer going to be part of the EU, Canada, a range of different places. China, India, Japan don't use full IFRS, but are very, very close. And are moving closer so every day. The US use something different. They use US GAAP. While there is contact between the US and the US standard setter and the international standard setter, and there is a level of similarity, they won't come together. Not in the near term anyway. And the idea is that once the International Standards Board issue a standard, before they issue it, the AASB provide input into the process, and then when we issue standards, we issue them which are in line with IFRS, which is really handy because it means that if you know how to read an Australian statement, you know how to read a statement in a whole range of different places. And if you know how to prepare a statement in Australia, you know how to do that in a whole range of different places. And that's pretty handy to have. There was a revised conceptual framework, and the idea of a conceptual framework is just like, what do they want accounting to be? Essentially, for those that aren't going to be doing further accounting, it's probably less relevant for you to be aware of it. But for those that are doing further accounting studies, you will touch more and more on the conceptual framework and the importance of it. For all of us, though, the objective of financial reporting is important. And I'll just quote this. So this is from Para 1.2. General purpose financial reporting provides a reporting entity's financial information in a way that is of use to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So again, that word decisions comes into play. Accounting is about providing information so that people can do something with it. And in this case, there's a focus on investors, lenders, and creditors, and about them providing resources. So whether it be about cash, investors providing cash or lenders cash, other creditors might be providing their time, their effort, whatever that they're going to be owed by the entity. And so if you're going to be owed by the entity, having an understanding of that entity's financial information is going to be important. When we talk about qualitative characteristics, there are a range of them that sit there. And this is kind of what we want that information to be. So we want it to be relevant. If you want to make a decision, that information needs to be relevant. For example, if you're wanting to buy a property, you would like to know what the value of the property roughly is today, as opposed to what it was definitely worth 20 years ago. It may not be 100% accurate, but the more relevant information is the information now. It should represent, that information should actually represent what it says it represents. So if they made a profit of $100 million, they made a profit of $100 million. You should be able to compare it with others because you want to be able to make investment decisions, for example. You should be able to verify it, or at least the auditor should be able to verify it. Relatively timely. If you're going to make decisions, you need timely information, and you should be able to understand it. But there is a comment in here that it's understandable by those who have spent, a reasonable amount of time. It doesn't have to be a long period of time to actually give themselves the skills so they can understand it. So not just the general layperson, but someone who spent a little bit of time and effort into understanding how accounting works. Okay, so the next section, and this will provide a good segue into next topic. So we're actually starting to look at the main elements within financial accounting. So the first three elements feature in the statement of financial position: assets, liabilities, and equity. So an asset is a present economic resource controlled by the entity as a result of past events. A couple of key things in this. One, it is a present resource. So you currently have that resource. And that economic resource is going to be of benefit to you. So you've got something right now which is of benefit to you. Secondly, you control it. Now, you don't ownership, you'll know it's not ownership, it's about control. So you can have something which you control but not own, and the flip of that, you can have something which you own but not control. Usually though, and for the most case of what we're dealing with, though, it'll be a one-to-one match. But an example of a really common example of something where an entity has control and has an asset but don't own it are airlines with their aircraft. A lot of aircraft are not technically owned by the airlines, but they are still controlled by the airlines, so they get counted as an asset. If you're interested, go and have a look at Qantas's annual report and have a look at the information about their property, plant, and equipment. And it's a result of a past event. So that sort of ties in with a present resource. But if I intend to buy, say, a new car, that new car is not an asset of mine. It hasn't happened yet. It has to have happened for me to be able to control it. Turning now to liabilities. A liability is a present obligation of the entity to transfer an economic resource as a result of past events. So it's kind of the flip. It's a present obligation. So right now, you owe somebody money. You owe somebody something. You are going to have to give something up, the transfer of an economic resource. Generally speaking, that would be cash, but it doesn't have to be. And it comes about as a result of something that has happened in the past. Using the car example again, if I intend to buy a car and I haven't done it yet, I do not have a liability to the car dealer because there has not been a past event. I do not currently owe them anything. Once I've bought the car and still owe them money, that's different. Now I have a liability. But the intention doesn't lead to a liability. It's when you actually owe them money that it does. And finally, and this would be recognizable for anyone with property interests, equity is not defined in as of itself. Equity is just what is left over. So equity is the residual interest in the assets of the entity after deducting all of its liabilities. So it's just assets minus liabilities. Turning now to profit and loss. Income are increases in assets or decreases in liabilities that result in increases in equity, other than those relating to contributions from holders of equity claims. So at a very simple level, I buy that car, I give the dealer, let's say $30,000. The dealer now has $30,000 more dollars. That is an increase in asset for the dealer. That is income for the dealer. There are ways in which this could be a decrease in liabilities, and we'll talk about those in weeks to come. But importantly, I'm not an owner in that dealership, so I'm not contributing money as an owner. So that is an increase in assets for the dealer, but nothing to do with equity. Nothing to do with a holder of equity. So it increases the equity of the dealer. They now have, their claim is now bigger internally. If I am an owner in a business and I have a capital injection, so I put more cash into the business, that means assets increase, but because it's coming from a holder of an equity claim, it is not counted as income. Turning to expenses are just the opposite. Expenses are decreases in assets or increases in liabilities that result in decreases in equity, other than those relating to distributions to holders of equity claims. We'll use a car example again. As the dealer gives me the car, they had an asset, they had that car, and it was counted as an asset for them. Now they don't have that car anymore, so there is a decrease in assets. Again, there are other ways this could happen, and we'll talk about them in weeks to come. Nothing to do with holders of equity claims. So when companies pay out dividends, that is a decrease in asset. Generally speaking, these get paid out in cash. Cash goes down, but they're going out to their distribution to the holders of equity claims, and so it's not an expense. It is just a reduction in equity. Again, we will look at these in more detail in topics to come. Your turn. So if you're in class, you would have done this. If you weren't in class, I would highly urge you to have a think about these things, because again, we understand this is potentially the first 45 minutes you spent looking at this stuff. We're not looking for necessarily a right answer on this. What's important is just to have a think about it, because by going through that and then sort of discussing this, and again, there'll be places on Canvas to do this, that will help you kind of crystallize some of this information and some of what we're looking at. So for each of the following, determine whether it's an asset, liability, equity, income, expenses, or nothing. There's a few tricks to this one. So the first one is you are owed $5,000 from a client related to an invoice you've already sent them. The second one, your staff are owed $25,000 for working the previous week and are yet to be paid. Third, you just bought $500 of Facebook ads and they ran immediately to help build your brand. And finally, you expect that maintenance costs in 2021 for machinery will equal $350,000. So if you haven't done this yet, pause the video, give yourself 5 or 10 minutes to do it, like really no more than that. Just have a quick think about it. If you would like some feedback, and you had to think about it and you would like some feedback and a way to discuss it with your peers or with myself, there's a discussion thread on Canvas, so please post up your thoughts there. Again, this is a safe space. If you've got any ideas, it's not about getting the right or wrong thing, but it's just about kind of your thought process and having a go. And as I mentioned earlier on, I am an accountant, and I think accounting is great, but it's important to recognize there are limitations with it. So firstly, there is a significant delay between year-end and information release. So most commonly, there's about 2 to 3 months between when the financial year ends and the annual report comes out. If you're trying to make trading decisions on that information is generally leaked out quite heavily into the market before then. So there is a timeliness issue with some of it, but it is still important. Annual reports still do service an important function. So it is important they still exist. Historical information. Information in financials based on past transactions It does not provide forecast information. True to an extent. A lot of information is historical in nature, but we're seeing an increasing number of balance sheet items which use fair value type accounting. And what that means, and it's not really the focus of this particular subject, but there are items, as opposed to, if you bought it 10 years ago and you kind of left it on the books at that same value, give or take some small adjustments, there are items where their values will move in line with whatever they're currently valued at, and shares are a really good example of this. So if you are an entity that has that owns shares in other entities and those are listed on the market, it's actually quite easy to get current valuations of those assets, and so you generally are required to show those holdings at whatever their current level is. So it's not entirely true it's historical, but there is still quite a strong element of that. There is substantial subjectivity in accounting standards. Yes, it allows for companies to make judgments and estimates, and this is going to be important because they need to understand their situation, and it is important to have a level of, for entities to have a level of control about what they present, because every entity is different. That does obviously cause a problem though, because it gives a means for companies to potentially misrepresent what they're doing. But it's not always cut and dried. I mean, and an example which I think we're going to see fairly shortly, if there's going to be a bit of a downturn, is that banks have to make allowances for losses on their loans, and banks' loan books are generally quite large. This isn't an easy estimate. These aren't easy things to do, and whether it should be X percent or slightly higher percent in terms of that allowance. I mean, that those are quite subjective decisions, and you hope with the independent auditor reviewing these things and a number of other checks and balances that they get to the right point. But again, there is subjectivity in there, and there should be subjectivity in there. There are also costs to accounting information, and look, it's just preparing this stuff. If you've got a multi-billion-dollar business with stores everywhere, with offshore entities with different currencies involved, it takes a lot to pull all this stuff together. So it's expensive to do. And so it's not a potential cost, that is actually a cost. Where a potential cost is, I suppose, the leakage of proprietary information. So there is a concern that information could be disclosed that could potentially be beneficial to somebody else. So, if a company was to be too granular with how it disclosed its, sales and cost of sales, potentially that gives competitors an idea about its margins, and that could assist them, in terms of kind of how they price what they do. So, there are real concerns about how much information is provided out to the market, because it could actually undermine what you're trying to do. So in summary, we looked at the accounting process, we looked at financial versus management accounting, business sustainability, sources of regulation, the conceptual framework, and finally, limitations and costs of accounting information. If you have any questions, please get in touch. There's obviously the Canvas discussion threads, but if you're not on Canvas, please use the comments below, and I'll respond as best I can. Thank you.